types of term loans and the costs and benefits of each. First is short-term loan. For example, working capital for a business covering unexpected expenses for the term, typically less than 1 year. And then cost, first higher interest rates compared to longer terms, then origination fees for processing the loan. For the benefits, fast disbursement of funds, and then suitable for immediate or short-term needs. Second, intermediate term loan. For example, financing equipment purchase, renovation, or inventory. For the term 1 to 3 years, then for cost, first interest rates are generally more moderate than short-term loans, and collateral assets used as security might be required. For the benefits, longer repayment period compared to short-term loans, easing cash flow, and then suitable for investment that will generate returns within the repayment time frame. And the last is long-term loan, for example, mortgage, auto loans, or business loans for expansion. For the term 3 to 25 years, then for the cost, first interest rates are typically lower due to the extended repayment period, but you end up paying more interest overall. And then collateral is usually required. Then for the benefits, it is lower monthly payment due to the extended repayment term, and it is suitable for financing large purchases that require longer repayment schedule. The nature and the content of loan agreements. A loan agreement is a legally binding contract between a lender and a borrower that outlines the terms and the condition of a loan. It typically includes the following information. First is loan amount, then interest rate, repayment period, repayment schedule, collateral, and covenants. Protective covenants are clauses in the loan agreement that safeguard the lender's interests by restricting the borrower's activities or financial ratios. Some common examples include financial covenants. This set limits on the borrower's financial ratios, such as debt to equity ratio or working capital ratio to ensure financial stability. Then, for dividend restriction, it is limit the borrower's ability to pay dividends to shareholders, ensuring retained earnings are available for loan repayment. And the last and next asset sale restriction prohibit the borrower from selling assets without the lender's consent, protecting the lender's collateral. And the last is change of control restriction, limit the borrower's ability to change ownership or management without the lender's consent, ensuring stability and continuity.
Next is about sources and types of equipment financing. Sources of equipment financing are commercial banks, finance companies, and equipment sellers. First, commercial banks. Traditional lenders offering term loans or equipment loans with competitive rates, but often require good credit and lengthy application process. Second, finance companies focus on providing equipment financing solutions, including leases and loans, with potentially faster approval but may come with a higher interest. And third, equipment sellers. Manufacturers or vendors may offer in-house financing options like conditional sales contract, simplifying the equipment acquisition. Next is types of equipment financing. First, chattel mortgage, a loan secured by the equipment itself. The borrower takes possession of the equipment, but the lender retains a lien on the title until the loan is fully repaid. If the borrower defaults, the lender can repossess. Second, conditional sales contract, an agreement where the seller retains ownership of the equipment until the borrower makes all the required payments. The equipment ownership transferred to the borrower upon successful completion of the contract. Equipment leasing provides flexibility as you only pay for the equipment's usage during the lease term. It conserves working capital and avoids the burden of equipment ownership costs like maintenance and depreciation. Fourth, sell and lease back. Unlock capital tied up in existing equipment by selling it to a lender and leasing it back. This frees up funds for growth initiatives or operational needs without selling the equipment entirely. Fifth, vendor financing. Offered directly by the equipment sellers or manufacturers, it simplifies the financing process by bundling financing with the equipment. And the last one is lines of credit. Function as revolving credit facilities that allow you to borrow funds for equipment purchases as needed, up to a pre-approved limit. This offers flexibility for ongoing or unexpected equipment needs.
Here are the primary types of leasing. First, operating lease. Operating lease is a short-term lease where the owner maintains ownership of its asset. Also, operating lease doesn't bear the risk of ownership such as maintenance costs and obsolescence. Second, sale and leaseback. Owner of an asset sell it to a leaser and lease it back from them. It commonly used for real estate and large equipment. Sale and leaseback provide immediate cash flow while retaining the use of direct lease. This arrangement directly between the leaser and lessee without involvement of a third party. Direct lease also provide flexibility in terms on conditions tailored to the leasing. Last, leverage lease involve a lender to providing a portion for the fund needed to purchase the asset while the lessor contribute equity. Leverage lease often used for high value like aircraft and real estate. That's all for our presentation. Thank you.